This is the image they told us we'd never witness: a Gulf Coast refinery struggling at half capacity, its flares flickering out like candles in the heart of a hurricane. For years, Canadian heavy crude was the lifeblood coursing through these pipes. This week, that life support was cut. With a single stroke of the pen, the sitting president imposed crippling tariffs on the very barrels these plants were built around, effective almost overnight. To the public, it seemed like just another chapter of tough-on-trade rhetoric, another North American shouting match. But behind the headlines, few bothered to look at the steel jungle along the Gulf Coast that would be left to pick up the pieces. This isn't just America imports a little less from Canada and buys a little more elsewhere. For the first time in decades, Washington has targeted the exact grade of crude that an entire swath of U.S. refining capacity was designed to process. The political slogan says, "We're energy independent. We've got shale. We don't need Canada." But the engineering truth is far different. Many of these refineries were designed, built, and financed on the belief that Canadian heavy crude would always flow in, cheap and reliable. In the next few minutes, we'll strip away the spin and expose three uncomfortable truths. First, why Gulf Coast refineries are locked in a lifelong, reluctant bond with Canadian heavy crude. Second, what it truly costs in time and billions to attempt to sever that bond. And third, which refineries and investors are most vulnerable to being crushed in this squeeze and who quietly stands to profit. By the end, whether you own a refinery, a portfolio full of refinery stocks, or a job inside one of these plants, you'll know whether you're clutching a life raft or shackled by handcuffs. Let's start with the trap. You've heard it time and time again. America is finally energy independent. Shale oil changed everything. We don't need foreign crude, not even from Canada. That's the myth. The reality is much darker and far more specific. Yes, U.S. production of light, sweet crude has surged, but the majority of the large Gulf Coast refineries were designed, expanded, and financed for something entirely different: heavy, sour crude that closely resembles the bitumen flowing out of Alberta, not the light shale from West Texas. Over the past 2 decades, Canadian crude exports to the U.S. have soared past 4 million barrels a day, breaking records as new pipelines and expansions came online. Almost all of it heads south, with a significant portion ending up in U.S. refineries. According to both Canada's energy regulator and the U.S. Energy Information Administration, Canadian crude intake has more than doubled from under 10% in 2000 to over 20% in recent years. In dollar terms, the energy trade between the two nations is valued at well over $100 billion annually. Now, zoom in on the Gulf Coast, and the picture becomes even clearer. PADD3, the Gulf Coast region, accounts for roughly 45% of total U.S. refining capacity, and a large portion of this infrastructure is specifically designed to process heavy sour crude. Coking units, massive desulfurization trains, high-pressure hydrocrackers, these aren't generic machines. They're engineered to crack, cook, and clean up dense, sulfur-rich crude that's a perfect match for Western Canada Select. Virtually all the Canadian crude flowing into the Gulf is of the heavy variety. To put it simply, think of light versus heavy crude as gasoline versus diesel. You wouldn't pour diesel into a gasoline engine and expect smooth operation, and you can't feed a refinery designed for heavy crude a diet of light shale and expect the economics to stay the same. Those colossal cokers, the towering machines that look like industrial cathedrals, are built to break down heavy fractions and turn them into high-value products. If you suddenly replace heavy barrels with lighter ones, those multi-billion-dollar machines sit idle, while parts of your plant designed for lighter materials are pushed to their breaking point. The yield pattern shifts. Margins that once thrived on discounted heavy crude, upgrading it into premium fuels, simply vanish. For years, Canadian heavy crude traded at a significant discount compared to other sour grades. After factoring in transport costs, that discount acted as a built-in profit boost for these refineries. You buy cheap, heavy crude, pour billions into the necessary infrastructure to upgrade it, and you rake in profits. The tariff strikes right at that gap. If it makes Canadian heavy significantly more expensive at the refinery gate, the equation shifts fast. So what happens inside the plant when that discount evaporates? First, your crack spread, the difference between crude costs and product prices, shrinks. Numbers that once comfortably hovered in the high single digits or low double digits can dip to break even. Second, your cash flow for maintenance and upgrades contracts. With a fraction of your usual free cash, anything non-essential gets pushed aside. Necessary maintenance that should be done this year gets deferred to the next, and the likelihood of incidents climbs. Third, projects that once seemed achievable, new units, debottlenecking, efficiency upgrades, quietly vanish from the capital plan. You won't see this on cable news, but you'll hear it in earnings calls, guidance cuts, delayed turnarounds, and the sudden halt of overtime long before anyone talks about layoffs. The timeline is cold and inevitable. Within a quarter or two, margins begin to show the damage. In a year or two, boards start questioning whether it makes sense to keep certain units, or entire refineries, operating when the core economic reason they were built has been wiped out by the tariff. On the ground, it doesn't feel like macroeconomics. It feels like this. Imagine a worker in Louisiana who spent the last 15 years on the same site. Last year, he was pulling double shifts during outages, picking up every extra hour he could. This quarter, overtime has vanished. Supervisors are talking about tightening the belt, aligning staffing with market conditions. HR starts holding listening sessions. Rumors swirl that one of the 3 major process units might be idled for good. For him, that heavy crude discount isn't just a line on a spreadsheet. It's the difference between covering his daughter's college expenses or telling her she'll have to take on more debt. Now, if these plants were built around heavy Canadian feedstock, the obvious question follows: why not just reconfigure them? If politics in Washington and Ottawa have made Canadian barrels pricier, can't the refineries pivot to U.S. shale or Middle Eastern crude and reoptimize? That's the second myth. If Canada gets too expensive, just flip the switch to shale or Saudi. Big refineries, they'll figure it out. But the reality, backed by every serious study of refining economics, is that meaningful reconfiguration isn't just a flip of a switch. It's a multi-billion-dollar, multi-year surgical procedure. Building a new, large, and complex refinery in North America is typically quoted in the range of $7 to $10 billion and takes 5 to 7 years, from concept to operation. Adding significant new capacity or complexity to an existing plant, whether it's installing a new coker or drastically changing the types of crude it can process, still requires billions and years, not months. A recent North American bitumen refinery project in Alberta, for example, cost mid-single-digit billions for just 150,000 barrels per day. Similarly, the expansion of a single coking unit at a U.S. refinery ran into the billions. Here's an analogy. You don't turn a heavy long-haul truck into a track-ready race car just by swapping the tires. You overhaul the engine, transmission, suspension, cooling system, and brakes. In a refinery, changing the engine means modifying or duplicating entire process trains, crude units, vacuum towers, distillate hydrotreaters, reformers, and the sulfur handling system. Changing the suspension is like redoing heat integration, flare systems, or wastewater treatment. Every single change triggers environmental reviews, permit applications, safety studies, and new operating procedures. Regulators don't just let you slap a new high-pressure, high-temperature system and call it a day. Major reconfigurations demand full stacks of environmental approvals, public consultations, engineering sign-offs. In today's regulatory and supply chain environment, acquiring the steel, specialized equipment, and skilled labor can add years and inflate costs well beyond initial estimates. Industry analysts often estimate that it takes 5 to 10 years from when a board signs off on a major configuration change to when the new setup operates smoothly. Now, add that to a mounting profit squeeze. The same tariff that makes your current heavy crude setup less profitable is also the environment where you're expected to find, say, $10 billion in capital and convince shareholders to wait a decade for returns. When crack spreads are fat, boards still hesitate to approve big projects due to the risk of massive cost overruns. When margins shrink and the outlook darkens, the bar rises even higher. So, if you're sitting around the boardroom table at a Gulf Coast refinery today, your slide deck holds 2 grim options. Slide 1, retrofit. $10 billion in capex, multi-year construction, permitting headaches, operational disruptions, and an internal rate of return that only looks appealing if you can count on stable policies and favorable market conditions through the 2030s. Slide 2, don't retrofit. Keep running the plant where your feedstock is more expensive, your plant's configuration mismatches with the cheapest barrels, and your margins are structurally lower than ever before. Neither slide looks good. That's why a third slide keeps showing up. Exit. Sell the assets to a major with deeper pockets and a more diversified portfolio, or slowly let the plant run down, invest only the bare minimum, and eventually shut it down. Imagine being the CFO in that room. You're weighing option A. Sink $10 billion into a complex plant, hope you can navigate the permitting, supply chain, and political minefield over the next 10 years, and pray that by the time it's done, the heavy-light dynamics haven't shifted yet again. Option B. Admit that the bet on cheap, secure Canadian heavy has been shattered by policy, and find a way to offload this risk, either by selling the site or by gradually winding it down. You're not debating how to grow earnings next quarter. You're debating whether your plant still has a future in the 2030s. If the first layer of this story shows how much U.S. refineries, especially on the Gulf Coast, rely on Canadian heavy, and the second layer explains how costly it is to rewire that dependence, the third layer is even more personal. Not all refineries are in the same boat. There's a comforting myth in the industry that we all hurt together, we all recover together, that every refinery will feel the pain from tariffs similarly, and that rising product prices will eventually lift all boats. But in reality, the boats are very different. You can roughly divide them into three categories. Group A, the hardcore heavy crude refineries, big cokers, deep desulfurization units, built to process a high percentage of heavy sour feedstock with minimal flexibility. Group B, the mixed diet plants. They can blend a substantial amount of heavy with light barrels depending on market conditions, and they have physical access to alternative supplies, like Mexican or even Venezuelan grades as sanctions shift, or Middle Eastern barrels. Group C, the most flexible. Coastal refineries with broad slate capability, or plants that have already spent big in recent decades to handle a wide range of crude types. Group A depends on the Canadian heavy discount the way a budget airline depends on cheap fuel. Their equipment thrives when they can buy dense, sulfur-rich crude at a substantial discount to global benchmarks, upgrade it, and turn it into high-value products. But when that discount narrows, whether due to tariffs or Canadian producers raising prices to stay afloat, their economics falter first. Group B has options. They can adjust their intake of Canadian barrels, blending with alternatives, though not without added cost. Group C, especially those embedded in integrated majors with their own production, trading arms, and other revenue streams, often manage to cushion refining losses through upstream profits or trading gains. For Group A independents, smaller to mid-cap firms heavily reliant on Canadian heavy and saddled with significant debt, the tariff shock is a direct hit. The risk isn't just a bad quarter, it's the possibility of shutting down one or two major units or being forced to sell the entire plant for a fraction of its book value. Group B will feel the margin squeeze, but, with aggressive and disciplined management, can likely weather the storm. Group C, on the other hand, may turn into buyers during the next wave of mergers and acquisitions, picking up distressed assets at fire sale prices when weaker players buckle under pressure. If you're an investor, worker, or supplier, understanding which group you belong to is no abstract thought. Imagine a fund manager who, 6 months ago, was all in on a mid-cap Gulf Coast refiner that had invested heavily in Canadian-optimized equipment. The strategy was clear. As Venezuelan and Mexican heavy crude declined, Canadian barrels would be the go-to feedstock, locking in strong margins. But once tariffs hit those barrels, the spreadsheet she built for the next 5 years turns to fiction. Forecasted cash flows collapse, debt ratios worsen, and the equity story flips from undervalued cash machine to possible takeover target or future write-off. Her decision isn't buy the dip or hold through volatility. It's exit before the market fully realizes how trapped this configuration really is. That's the structural picture. But these decisions don't happen in a vacuum, and they don't unfold overnight. Over the next few months, several realistic paths could unfold for refineries tied to Canadian heavy. In the base case, the pain is real, but the system holds together. The tariffs stay in place, but Canadian producers and U.S. buyers quietly negotiate deeper discounts to keep volumes flowing. Canada, heavily reliant on the U.S. market, has few short-term alternatives, so they absorb more of the cost to maintain relationships. On the Gulf Coast, margins are squeezed but not destroyed. Capital expenditure is pulled back. Overtime is slashed. Hiring freezes are implemented, but mass closures don't happen immediately. The signals to watch here are the differentials, the spread between Western Canada Select and benchmarks like Brent or Mars. If that discount widens enough to offset the tariff and keep refineries operating, you're in a painful but stable equilibrium. In a more dangerous second scenario, the situation escalates. Ottawa feels cornered, and instead of absorbing the tariff, starts diverting shipments to other markets where possible, tightening logistics to the US, or prioritizing exports to Europe and Asia. Even a modest shift matters when nearly all Canadian crude flows south. Heavy crude supply to the Gulf Coast actually drops. Some refineries are forced to cut production below 80% capacity because the right barrels simply aren't available at a reasonable price. Signs of this would be clear. Increased volumes of Canadian crude showing up in non-US markets, public statements about diversifying markets, and heightened discussions around trans-mountain and Pacific routes. There's also a third scenario, a partial climb down, at least on energy. Political pressure inside the US, from states hosting refineries, unions, and fuel price-sensitive voters, builds to the point where carve-outs for energy are quietly reinstated. The administration maintains a hardline posture on paper, but quietly exempts or reduces tariffs on crude and key feedstocks. The heavy Canadian discount partially returns. Watch for leaks about temporary waivers, emergency consultations between Gulf Coast refiners and trade officials, and sudden shifts in customs policy that seem to open back doors. For now, we know a few undeniable facts. Canadian exports to the US have been at or near record highs, largely consisting of heavy grades that these refineries are optimized to process. US refineries, especially in PADD3, are running near historic rates and are highly reliant on heavy crude to keep their cokers functioning. We know margins have been squeezed, and some independent refiners have already tempered their outlook. What's still missing is a formal, lasting energy carve-out. Until that appears, the risk clock keeps ticking. But refineries don't operate in isolation. Every time a Gulf Coast plant adjusts its crude mix, trims production, or revises CapEx plans, ripples reverberate across the entire energy system. If tariffs make Canadian heavy crude less attractive in the Gulf, Canadian producers will accelerate their search for alternative markets. Expect more focus on West Coast and Pacific routes, growing interest from Asian refiners hungry for heavy feedstocks, and increased efforts by Canada to deepen ties with countries far from Washington. Once those relationships mature and infrastructure is established, reversing the flow back to the US won't be as simple as turning a ship around. On the US side, refiners, now battling harder for heavy barrels, will turn to Mexico, any available Latin American heavy, and Middle Eastern grades, assuming logistics and politics allow. This competition drives up the global price of heavy crude relative to light. Traders and sovereign wealth funds take notice, placing long-term bets on refineries and companies capable of handling diverse crude types and reducing exposure to those tied to a single supplier and discount. There's also a shift in the narrative. The once comfortable slogan of energy independence starts to unravel as the market sees how many U.S. refineries rely on imported heavy barrels, often from a single dominant source. True energy independence would mean the ability to swiftly switch between feedstocks without breaking the economics. But that's not the reality for most refineries today. You don't call a patient fully independent when their heart is functioning, but a critical artery is still plugged into a neighboring hospital's life support system. That's where the Gulf Coast stands with Canadian heavy crude. That artery has always been there, always pumping until someone cranks up the bill. So what does all of this really mean for you? If you're not a politician, but someone whose livelihood is tied to steel and pipes along the Gulf Coast? If you're sitting in the executive suite of a refinery heavily reliant on Canadian feedstock, there are 3 numbers you should monitor closely. The first is the differential between Canadian heavy crude and your main competing sour grade, typically a Gulf Coast benchmark. If that spread doesn't widen enough to offset tariffs and added costs, your core strategy is under threat. The second is your utilization rate. How many weeks or months are you running below, say, 85% capacity? Short-term dips are noise. Sustained underutilization is a warning sign. The third is your credit spread, the premium the market demands to lend your company money. Rising borrowing costs are the bond market's way of signaling that it sees increased risk. On the action side, this means facing the hard truths in your scenario planning. What does your business look like if margins stay compressed for the next 3 to 5 years? Can you afford to keep every unit running? Does a retrofit clear your internal hurdle rate under realistic assumptions? If not, who might buy the asset? And on what terms? How much negotiating power do you truly have left with Canadian suppliers if they're also under pressure to diversify? If you're managing a fund with significant exposure to refiners, your first job is to stop pretending all these assets behave the same. Sort your portfolio into Group A, B, and C, and treat them like fundamentally different bets. Independent refiners with heavy crude exposure and leveraged balance sheets sit in a far riskier bucket than integrated majors that can offset refining pain with upstream gains or trading arm profits. Look beyond headline earnings. Pore over the footnotes where management discusses feedstock flexibility, capital allocation, and strategic alternatives. Hedging in this world isn't just buying a crude futures contract. It could mean trimming positions in pure heavy crude plays, increasing allocation to more flexible refiners or infrastructure names that benefit from whatever path Canadian barrels take, or even positioning for an M&A wave where stronger players scoop up distressed plants on the cheap. And if you're a worker or a supplier tied to one of these refineries, the macro narrative boils down to a brutally simple sequence that always shows up when margins are crushed. First, overtime disappears. Then extra contractors are let go, and shifts get consolidated. Next comes the hiring freeze. Only after months of that do formal layoff announcements hit. The people feeling the shock first aren't necessarily the ones on the main payroll. They're the welders, inspectors, truck drivers, and local businesses whose incomes fluctuate with the plant's run rate. The uncomfortable truth is this: upskilling and diversification are no longer nice to have. The more you can move into roles that are needed, whether a particular refinery runs heavy or light, maintenance, safety, utilities, grid operations, the more options you preserve if your current site is sold, idled, or shut. We've just walked through the heavy crude trap, the mirage of an easy retrofit, and the shifting landscape of who stands where as the ground quakes beneath Gulf Coast refineries. The core point is simple. You cannot tax the structural backbone of a system and expect only your trading partners to feel the pain. When your plants were engineered around a very specific artery of supply, hitting that artery reverberates up and down the entire body. Trying to separate the Gulf Coast from heavy Canadian crude with a blunt tariff is like trying to swap an athlete's blood mid-marathon without a plan, without a surgeon, and with nothing but a dull knife. Maybe they limp on. Maybe they stagger across the finish line. But the more likely outcome is they collapse on the track and take a long time to rise again. If you're in this world, running a plant, selling services to one, or putting serious money on their balance sheets, how are you reading this moment? Does it feel like a passing squall that will blow over with the next election cycle, or like the first tremor of a deeper restructuring of who refines what and where in North America? If you're on the Gulf Coast, your view from the control room or the parking lot is worth more than 1,000 analyst notes. Put it into words. The policymakers rarely hear from the ones watching the flares. In the next chapter, we're going to follow the barrel. If Canadian heavy faces enough damage, who realistically fills that hole? Venezuela clawing back from sanctions, Middle Eastern producers with their own agendas, or no one at all? What do trapped refineries actually do when the numbers force a decision? Spend billions and wait a decade, sell, or quietly plan for shutdown? And how does that ripple forward into gas prices and the energy bond market heading into 2027? If your portfolio or your paycheck is tied to this sector, you want those answers.